How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk to everybody about deposit strategy. I came across a great blog post this week from the PCBB, basically offering up 5 different strategies that banks should be considering when trying to manage your deposits as we are entering into an interest rate reduction cycle from the Federal Reserve. So let's pull this up and take a look at what we got here. So basically, this blog post is titled, Are Deposit Costs Finally Easing? So after the first interest rate cut in over a year, we look at the outlook for deposit costs and offer 5 strategies for banks to maximize the opportunities in this uncertain environment. So one of the paragraphs in here basically says deposits, albeit of a different kind, are also highly prized by financial institutions. As a result of the Federal Reserve's quantitative tightening, U.S. banks experienced 6 consecutive quarters of declines in deposits. According to McKinsey, between the fourth quarter of 2022 and the third quarter of 2023, money flowed out of mid-sized U.S. banks to the tune of 11% for the $100 billion to $1 trillion segment and 5% for the $10 billion to $100 billion segment. The largest and smallest banks each added 2% to their deposits. The rest was mostly lost to the money markets. Growth finally resumed in the fourth quarter of 2023 with an uptick of 2% by the first quarter of 2024. So this has come at a cost to banks, as they have had to defend their deposits with increasingly higher rates in order to narrow the gap with high yielding alternatives in the treasury and money markets. With the first interest rate cut of 50 basis points this month, there is hope for relief. However, it is likely that a decline in deposit costs will lag the Fed's easing cycle. Even with declining interest rates, banks under regulatory pressure to maintain liquidity will remain focused on boosting and retaining deposits while improving margins. So in this challenging environment, it is essential to be prepared. So we explore 5 strategies to ensure your community bank is ahead of the game. So let's take a look at the 5 strategies offered real quick. So number 1, plan ahead, review, and adjust your deposit mix. Number 2, determine a nuanced pricing strategy. Number 3, balance liquidity need with cost management. Number 4, launch targeted campaigns to reclaim lost deposits. And number 5, prioritize relationship building to reduce funding costs. And obviously, funding costs are at the heart of what's going on here. The Federal Reserve went on one of the most aggressive rate tightening cycles that they've ever been on. They did 11 straight interest rate increases. This happened from 2022 into 2023. And as a result of that, it dramatically increased banks' funding costs, i.e. the amount of interest that banks have to pay out on the deposits that they have. And banks had to do this to, number 1, retain, but then number 2, attract new deposits. I would say for many banks out in the market, that has come in the form of higher CD rates, perhaps higher money market rates, maybe not as much emphasis on higher savings or checking account rates. Some banks have done that, but I would say that probably it would be fair to say the most or the majority of banks have really focused on increasing CD and money market rates to try to retain and attract many of their customers out there in the market. So, under number 1, plan ahead, review and adjust your deposit mix. They talk about evaluate current holdings and anticipate customer behavior. And I think that the second one there is a huge one. But under evaluate current holdings, so analyze your existing deposit portfolio to understand the distribution between short-term and long-term products. With 1-year treasury rates dropping, it's likely that CD prices will follow suit. Assess whether it's time to shift your focus toward products that better align with the new rate environment. In other words, if you've got money out on 1, 2, 3-year CDs, well, maybe you might want to look at 6-month CDs, something like that. Anticipate customer behavior. Consider how customers might react to rate changes, especially those with a history of rate sensitivity. Prepare to offer alternative products or incentives to retain funds that might otherwise be moved. So you're always going to have a certain number of customers that are what we would call or describe as rate sensitive. You're probably going to have, I would say, somewhere in the neighborhood of 20%, maybe even 30% of your customers that, they're going to move based solely on whatever the rate is. Whoever's got the best rate, when their CD matures, they're if you don't have the best rate, they're going down the street to whoever does. So you've got that amount out there. But I think the bigger thing to look at here is kind of the psychology of the moment. Basically, behavior. You could think of it as behavioral economics. People, especially younger people, for the very first time, they have actually had a chance to the what's called the interest risk, or the risk-free rate, has been returned to the marketplace. I've talked about this in many episodes. If you're 35 or younger, this is probably the first time in your adult life that you've actually had a chance to go into a bank, or maybe even a brokerage or whatever, and put money down and make 5% interest, risk free, without having to put your money in the market, without having to effectively really risk your money. You put it in there, you get your 5% return, and hey, life is good. I don't think a lot of customers are going to be so quick to give that up. And I think that gets back to, okay, how are you going to anticipate the customer behavior? When we go back up here, where it says here, however, it is likely that a decline in deposit costs will lag the Fed's easing cycle. I think that also plays into a little bit of that. You have to retain the customers that you have, because you got to have the deposits to fund your loans, right? If you're going to get, if people, and especially if rates drop and loan demand picks up, you're going to have to continue to have those pricing there. So just something to again, all of this is just something to think about as you're going over your deposit mix, as you're thinking about your strategy. So let's move on to number 2 here. Determine a nuanced pricing strategy. So conduct price sensitivity analysis. Different customer segments will respond differently to rate changes. Yes. Use data analytics to understand these variations in price sensitivity and tailor your pricing strategy accordingly. This approach allows you to retain rate-sensitive customers while maintaining or improving your net interest margins. Segment and target. Develop a pricing strategy that segments customers by their rate sensitivity and financial behavior. For instance, offered tiered interest rates or bundled products to attract and retain deposits from those most likely to seek higher returns elsewhere. So in other words, if you have that 25 to 30-year-old, hey, can we bundle a product here, maybe with a savings account and a money market, that we can do something with tiered interest rates to try to, entice them to stick around, or maybe entice them to come over. That in and of itself could be a strategy. Maybe you say, maybe a few more rate cuts, and maybe a lot of banks start to say, hey, you know what, we're going to go down to, we're bringing our CD rates down to 3%, bringing the money market back down to maybe a point, something like that. Maybe your strategy would be to just stay a little bit ahead of that. Maybe you'd say, okay, well, we're gonna keep our rates at 3.5 or 3.75 on our CDs. We're going to keep our money market rate at 2% or 2.5 to try to not only retain, but to attract some new deposits. Again, depending on that demographic, are you looking to hold on to some of those older money from some of the baby boomers? Or are you looking to maybe bring in some new money from Gen Z clients? So think of things like that. Okay. Number 3, balance liquidity needs with cost management. So strategic liquidity management. In the wake of recent bank challenges, maintaining ample liquidity is crucial. However, it's equally important to manage the cost of funds. Revisit your liquidity strategies to ensure you have sufficient access to funding while minimizing the impact of reduced deposit rates on your balance sheet. ALCO. Ensure that your ALCO committee's objectives are being met. And then diversify funding sources. Keep multiple funding channels open and ready to activate, i.e. line of credit. This might include lines of credits, wholesale funding, or alternative financing options that provide flexibility without excessively increasing costs. So in other words, broker deposits, lines of credits, things of that nature. Keep those things active. I think ALCO is the big key here. Most banks, I would say most, you can never, I hate using the word all, because then that imposes generalities. And I like to just say most. I think most banks out there have ALCO committees, and they probably meet on average, I would say, once a month. Maybe some banks have like a quarterly type meeting or something like that. I almost feel like over the next year, your ALCO committee should, maybe not like every week, but you should be meeting more than once a month. Like you might even want to do every 2 weeks. Because I think we're going to get into that kind of I think we're going to get into a type of rate environment that we haven't literally seen in a long time, where you're fighting to try to keep those deposits in place, and you're going to have to monitor what's the market doing, what's your competition doing, how are things going. And I think that you're going to have a lot more conversation on this as time goes on. So just again, food for thought, things to think about. Launch targeted campaigns to reclaim lost deposits. So data-driven outreach. Use your customer data to identify those who shifted funds to money market accounts or other higher yield options during the rate hikes. Develop targeted campaigns that offer compelling reasons for them to return, such as promotional rates or bundled services that enhance the value proposition. Tailored product offers. Consider offering products that align with the current rate environment, such as step-up CDs or loyalty bonuses for returning customers. These can be effective in regaining lost deposits and reinforcing customer loyalty. And I think that's a great thing. Consider or look at how are you going to reclaim lost deposits. I think that's a great, that should absolutely be a discussion that you're having when you're talking about your deposit mix, not only retaining what you have and not only trying to get new customers, but hey, how do we get back some of the customers that we lost? And then finally, number 5, prioritize relationship building to reduce funding costs. So deepen customer engagement for commercial clients. McKinsey estimates that the return on equity on clients with primary banking relationships is approximately 20 percentage points higher than for clients with a lending-only relationship. So strong relationships with clients, particularly in commercial banking, can lead to lower funding costs and higher returns. Focus on enhancing the customer experience through personalized services, proactive communication, and relationship-based pricing. Cross-sell and upsell. Use the opportunity to deepen relationships by cross-selling other services that can lock in primary banking relationships, thereby reducing the likelihood of deposit attrition when rates fluctuate. Offer financial planning, cash management services, or advisory services to strengthen ties with your clients. Yes, I think cash management is a key thing here. So say you have a customer that is it's a loan only relationship, and you're trying to build the deposits with that customer. Well, one of the pushbacks you might get is they might say, well, listen, I don't want to leave big chunks of cash just sitting in a non-interest bearing account. I want to try to make something on my money. Well, that's where cash management comes in. And you can say, hey, listen, we can do sweep accounts. Talk to them about sweep accounts. We sweep your money overnight, try to get you to earn a little interest, bring the money back. But cash management in particular, sometimes, particularly with business customers, they need analyzed checking. Particularly, they need, fraud prevention. I'm trying to think of the fraud program. It's slipping my mind right now. I'll think. Give me a second here. Hopefully, it'll come back to me. But yeah, I mean, they might need fraud services though to make sure that fraudulent checks are not getting posted against their account. And then finally, it wraps up basically by saying, relationship building at the core of many banks' deposit strategies. True to banks' reputation for service, many institutions have chosen to focus on relationship building rather than engage in a price war. Yes, I absolutely agree with that. I think that, relationship banking should be at the core of everything you do, especially if you're a small bank, if you're a community bank. Banks at their heart are built on the concept of relationship banking, and that should always be your focus, and you should never, ever, ever lose sight of that. So, but I thought that this was a great article, and I thought this was a great opportunity to kind of talk about some of these things here that are going on today. I will talk a little bit more, I think, in future episodes about deposit mix, about ALCO, about how the ALCO committee works, gap analysis within the ALCO committee, and how that plays into deposit strategy. I'll talk about funding costs and how that affects a bank's net interest margins, basically their profit margin, as it were. So I hope this was a good episode. I hope you enjoyed it. If you did, Please make sure to like, share, and subscribe. That always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below. And if there's anything else that you'd like to hear related to kind of deposit or deposit strategy, please be sure to drop me a line at info@thebankernextdoor.com, and I'd be happy to look at what other episodes I might be able to provide. But until next time, have a great time out there. I'll see everybody again real soon. Thanks a lot.